Good evening, sir.
Okay, so thank you. This night, we shall be looking at capital gain tax. We are going to look at capital gain tax this night. So from where we stop this night on capital gain tax, we still continue next week. So capital gain tax will take us for about 2 lectures. So last week, we talked about tax practice in Nigeria. So far, we have done like 4 to 5 topics. So this one will make it the 6th topic. So capital gain tax is a tax imposed on a gain arising from disposal of tangible assets. When we talk about this capital gain tax is regulated under the Nigeria Tax Act 2025. There is a particular section under the NTA 2025 that talk about capital gain tax. So that means this NTA 2025 has repealed the old capital gain tax act we have. So currently, we don't have any capital gain tax act. And the regulation, the law that regulates capital gain tax is stated under a particular section in Nigeria Tax Act 2025, such as Section 32s and so on. So that is what we have on this capital gain tax. It is a tax imposed on a gain arising from disposal of what? Tangible assets. What do we mean by that? When we dispose fixed assets. When we dispose fixed assets, like plant and machineries, land and building, furniture and fittings, and so on like that. When we dispose such kind of assets, we now make a gain. Such gain will be subjected to capital gain tax. E.g., I bought a land in 2021 for a sum of 20 million naira. So now, this is 2026. I wanted to sell the land. So the land is now going for about 125 million naira. So the difference between the sales proceed of the land, which is 125 million naira, and the cost of acquisition, 20 million naira, that is 105 million naira. That is the capital gain. So you will pay capital gain tax at the rate of 30% on it. So that is capital gain tax. So capital gain tax was incorporated into the NTA to ensure that we have a unified tax system, so that the law that govern personal income tax, the law that govern company income tax will be the same law that regulate capital gain tax. So they are still all these company income tax, personal income tax, capital gain tax, petroleum profit tax, they are still under Nigeria Tax Act 2025. So, like we said, it is a gain, it is a tax imposed on a gain arising from disposal of tangible assets. The word tangible asset can be fixed asset, either tangible fixed asset or intangible fixed asset, like cryptocurrency and so on like that. So that is on capital gain tax. When we make a gain, while we dispose our fixed asset that we are currently using, such gain will be subjected to capital gain tax. So administration of capital gain tax. Who administer capital gain tax? Administration of capital gain tax depends on who make the gain, who receive the gain. If the gain is made by corporate entity, corporate bodies, or non-resident individual, so the administration of capital gain tax is going to lie on the Nigeria Revenue Service. That means what we are saying in essence is a gain made by a company or a non-resident taxpayers that gain, the capital gain tax, is going to be collected by the Nigeria Revenue Service. So anything that have to do with assessment, collection, return, repayment of capital gain tax accrued to a company or corporate entity, such responsibility lies with the Nigeria Revenue Service, formerly called FRS. Now, still on the administration of capital gain tax, when we talk about capital gain tax that relate to when a gain is made by an individual or a sole proprietorship or a partnership or a trustee, such capital gain tax is going to be administered by the State Internal Revenue Service or State Board of Internal Revenue Service. So the administration of capital gain tax in respect of a gain made by an individual, sole proprietorship, partnership, trustees lies with the State Internal Revenue Service. That is on the administration of capital gain tax. Now, what is the basis of assessment of capital gain tax? How do we assess capital gain tax into tax? Prior to NTA 2025, before the Nigeria Tax Act was enacted, was implemented, that means before 1st of January 2026, prior to that date, under the old Capital Gain Tax Act that we have, Capital Gain Tax Act is administered on actual year basis under the old tax law. But with the implementation of the NTA 2025, Nigeria Tax Act 2025, capital gain tax is now administered on preceding year basis. That means capital gain tax accrued to individual for 2026 is going to be assessed to tax in 2027 year of assessment. So capital gain tax is now administered on preceding year basis compared to last year, where capital gain tax is administered on actual year basis under the old law. So now capital gain tax is administered on preceding year basis. So that is on capital gain tax. So the gain arising from disposal of chargeable assets for 2025 is going to be assessed to tax in 2026 year of assessment. That is what we mean by capital by preceding year basis. So, and filing of return for capital gain tax. The return for capital gain tax, if it is company, such return must be filed along with the company income tax return, which is 6 months after the end of the accounting year, or 18 months from the date of commencement of business, or from the date of incorporation. So when we talk about filing of capital gain tax return, if it is company, a company must file capital gain tax return within 6 months after the end of the year. That means they must file it along with the company income tax return. But if it is an individual, in the case of partnership, sole proprietorship, individual, they will file their own capital gain tax return 31st of March of the following year while they are doing their direct assessment return. So if a gain is made by an individual, sole proprietorship, partnership, and so on like that, the capital gain tax return must be filed not later than 31st of March of the following year. So that means if the individual want to file their self-assessment return, you know, every individual, either you are an employee, or you are a sole trader, or you are a partnership, the law mandates that you must file your self-assessment return not later than 31st of March of the following year. The self-assessment return under personal income tax is different from the one filed by the company on behalf of the employees. So that self-assessment return under personal income tax is different from the one filed by the company on behalf of who? On behalf of the employee. The one filed by the company on behalf of the employee, that one is filed not later than 31st of January of the following year. But under the NTA, there is a particular direction now that every individual, either you are employee or you are not an employee, you are sole proprietor, you must file a direct assessment return, self-employed return, not later than 31st of March of the following year. So what we are saying in essence is, when we talk about filing of capital gain tax return, if the return is want to be filed by company, that return must be filed along with the company income tax return, which is 6 months after the end of the year. So in the case of individual partnership, the return must be filed not later than 31st of March of the following year. So that is it. Now, who are the persons liable to capital gain tax? Let's look one example here. I gave an illustration example. I said a company disposed a chargeable asset on 15th of August 2026. So if a company disposed a chargeable asset on 15th of August 2026, so when is the deadline for filing return on that capital gain tax? So that means that company must file the return on this transaction along with the company income tax return within 6 months after the end of the accounting year. If it is an individual, take for instance, an individual that disposed a chargeable asset on the 20th of October 2026. So that capital gain tax on that chargeable asset must be filed while the individual is filing their income tax return in the 2027 year of assessment and not later than 31st of March 2027. Now, person liable to capital gain tax. Who are the persons liable to capital gain tax? Who are the persons liable to capital gain tax? Who are the persons that are responsible for payment of capital gain tax? Capital gain tax is payable by any person who realize a gain from disposal of chargeable assets, unless such gain is specifically exempted under the Act. If you are a company, you are individual, or you are a partnership, you are a trustee, you are administrator, you are executors, when you make a gain from disposal of a chargeable asset, such chargeable asset will be subjected to capital gain tax. So when we talk about the persons liable to capital gain tax, we talk about individual, resident individual, non-resident individual. Apart from individual, resident individual, non-resident individual, we have a partners too. Partners too is liable to capital gain tax. Trustees, they are also liable to capital gain tax. All companies too, they are liable to capital gain tax on chargeable assets disposed. So when they ask you who are the persons liable to capital gain tax, you need to mention resident individual, non-resident individual, partners, trustees, companies. All companies, they are liable to capital gain tax. Now, we have looked at the persons liable to capital gain tax. When we look at the definition of capital gain tax, we said capital gain tax is a tax imposed on a gain arising from what? Disposal of chargeable assets. The word disposal, what do we mean by disposal? Disposal under the old tax law, section 6 specifically define that disposal. They said disposal of an asset mean when any capital sum is derived. So we want to define disposal because based on the definition of capital gain tax, we said capital gain tax is a gain arising from disposal of what? Chargeable assets. So that concept called disposal, what do we mean by disposal? So in relation to capital gain tax, when you look at the old capital gain tax law, section 6 of that particular of that act, provide that disposal of an asset by persons is when any capital sum is derived by what? By way of sales, lease, transfer, assignment, or compulsory acquisition of assets. So when we talk about disposal, that means we mean under capital gain tax. When we talk about disposal under capital gain tax, that means is when disposal of an asset by a person and a capital sum is received. So disposal under capital gain tax means when any capital sum is derived or received from sales, lease, transfer, assignment, or compulsory acquisition of an asset. So that is the meaning of disposal under capital gain tax. Where any capital sum is derived from a sale, lease, transfer, assignment, or compulsory acquisition of an asset, that means that is what disposal means under capital gain tax. Now, see under the concept of disposal, you may be asked, what are the specific circumstances where disposal is deemed to have taken place? What are the specific circumstances where disposal is deemed to have taken place? What are the circumstances where we are going to say, disposal have taken place? So what are those specific circumstances? Number one, where any capital sum is derived by way of compensation for loss of office or employment. When you are giving compensation for loss of your job, disposal have taken place when you receive that compensation. Or for any injuries suffered, maybe you have an injury or your car was damaged by a third party, that means disposal have taken place. So number one circumstances where disposal have taken place is where any capital sum is derived by way of what? Compensation for any loss of office or employment. Another one, where any capital sum is received under policy of insurance. Where any capital sum is received under what? Policy of what? Insurance or risks. Where any capital sum is received under policy of insurance and the risk of any damage or injury. So in that case, disposal too have taken place. Another circumstances where disposal have taken place is where any capital sum is received in return for forfeiture or surrender of right. This one applies to patent right, copyright, trademark. When you receive a capital sum for giving out your patent right, your trademark, your copyrights, that means disposal have taken place. So these are one of the circumstances where disposal has taken place. Another circumstances where disposal has taken place, where any capital sum is received in consideration for use or exploitation of assets, where any capital sum is received in consideration for use or exploitation of assets. This one have to do with lease of an asset. When you lease your asset, you receive a rent, you receive a lease renter, you receive a payment, a lease payment from leasing your asset. So in such instance, disposal have taken place. Another one, another circumstances where disposal have taken place, where any capital sum is received in connection with or arise by virtue of any trade, business, profession, or vocation, where any capital sum is received in connection with or arise by virtue of any trade, business, profession, and vocation. In such instance, disposal have taken place. So somebody raised, you want to ask a question? You can go ahead.
No, sir, I don't want to ask a question. I was trying to understand the number 2 point, but then I realized that in insurance claim, for example, whereby when an individual have an accident and the insurance now pay a claim to the individual. So I wanted to ask, can we say is there a disposal process or?
That is a disposal. It's an example of disposal.
Okay.
Yes. So it's an example of disposal. It's an example of disposal. So that is what we need to know on disposal of assets under the capital gain tax. Now, what are the next area we need to look at is allowable expenses and disallowable expenses under capital gain tax in Nigeria. What are the allowable expenses and disallowable expenses under capital gain tax in Nigeria? There are some expenses. When you incur them, you can add it as part of your cost under capital gain tax. If you want to compute your capital gain tax, you can remove it from your sales proceed. So such expenses are called allowable expenses or deductible expenses. So what are those allowable expenses under the capital gain tax? Number one, the cost of acquisition, the cost that you use to acquire that asset, which may include the purchase price and all incidental costs to purchase, the cost that you use to purchase the asset, and any cost you incur at the time of purchasing the asset, like carrying costs, like stamp duty, like value-added tax, like custom duties, freight charges, and so on like that. Any other costs you incur at the point of purchase of the assets, they are part of the cost of acquisition. So one of the allowable expenses under the capital gain tax is cost of acquisition. Another allowable expenses under the capital gain tax is what? Improvement costs. Improvement costs. The cost you incur to improve the life of an asset. That asset, the cost you incur to improve the life of the asset, they are part of the cost of acquisition. Like renovation costs. That building that you want to sell, you have to renovate it. You have to change the roof. You have to paint it. You have to do some work. Such is part of allowable expenses. So it is an improvement cost. Because if you don't improve the asset, it will not attract the prospective bidder, the prospective buyer that want to buy the assets. So you have to improve it before you sell it, because you have been using the asset for so long. So you now decide that you want to sell it. Before you sell it, you can spend some improvement costs to improve the life of the asset, like painting it, change the roof, do some minor repair. So it's part of allowable expenses. Another allowable expenses is costs incurred in establishing, preserving, defending the owner title to right over the assets. That means the legal costs incurred to defend the title to the land, to the right to the use of the assets. They are part of the cost of acquisition. Costs incurred to defend the owner title to a right over the assets is also part of allowable expenses. Another allowable expenses under the capital gain tax that we have is incidental cost of disposal. Incidental what? Cost of disposal. What do we mean by this? Incidental cost of disposal means those costs we incur at the point of disposal of the assets. While we want to dispose the asset, we have to incur some costs, like advertisement costs to find the buyer of the asset is part of incidental cost of disposal. Agency fee, the agent that bring the buyer, we have to pay the agency fee, is part of incidental cost of disposal. Valuation fee, maybe they have to value the asset before they sell the asset, is part of incidental cost of disposal. Change of agreement fee, you have to change agreements. Change of title, deed of assignment, is part of incidental cost of disposal. At the point of change of title to the owner, change of ownership, you may pay stamp duties too. It's part of incidental cost of disposal. So under the incidental cost of disposal, we may have advertisement costs, we may have agency fee, we may have valuation fee, we may have legal fee, we may have cost of transfer or conveyance, including stamp duty. So all these, they are what? Incidental cost of what? Disposal. Any other cost that will be incurred, that will improve the assets to make it attractive to the buyer, so that the buyer can say, this asset, I want to buy it. Any other cost that will be incurred, so that that asset can be of value to the prospective buyer, can attract the buyer. So such is part of, they are part of incidental cost of disposal. So now, disallowable expenses under the capital gain tax. What are the disallowable expenses under capital gain tax? What are the disallowable expenses under capital gain tax? Disallowable expenses under capital gain tax. Number one, all the allowable expenses that is recognized for computing adjusted profit under company income tax and personal income tax. Any allowable expenses that have already recognized in the computation of adjusted profit under company income tax or personal income tax, they will be disallowed under capital gain tax. What we are saying in essence is we cannot make double claim. If an expenses like printing and stationery, we have incurred such expenses, we have allowed it under company income tax when we want to compute adjusted profits. Such expenses will not be allowed again under capital gain tax. So, number one disallowable expenses under capital gain taxes, all the allowable expenses recognized in the computation of adjusted profits under the company income tax and personal income tax, they are disallowable expenses under capital gain tax. Insurance premium on the asset too. When you insure the asset, you pay insurance premium on the asset. It's not allowed under the capital gain tax. Insurance premium you pay on the asset will be recognized under company income tax. Another one, higher purchase interest. In case you buy the asset on higher purchase, the interest accrued on that transaction, the interest, the difference between the higher purchase price and the cash price, that is the higher purchase interest. That interest is also disallowable expenses. That means, take for instance, you buy a motor vehicle, you buy it on higher purchase, 10 million naira. Assuming you want to buy the car on a cash price, you will pay 7 million naira. Because you want to pay on installment and you have it is on higher purchase. That is the reason why they say you should pay 10 million. So the difference between that 10 million and the cash price, if you want to pay now, immediately, you will pay 7 million. The difference between 10 million and 7 million, that is the higher purchase interest. Such interest is a disallowable expenses. If over the years, you now dispose that motor car, if you want to compute your capital gain tax, assuming you dispose the motor car, maybe after 3 years, after 4 years, or after 4 years, you dispose the motor car for 15 million naira. So if you want to compute your capital gain tax, sales proceed 15 million, less the cash price 7 million. That is how you are going to compute your capital gain tax. 15 million less the cash price 7 million. You will not say 15 million less the higher purchase price. No, you will not recognize the interest. So higher purchase interest is disallowable expenses under capital gain tax. Bad debt, too, in the case of default in payment by the buyer. Bad debt in the case of default in payment by the buyers too. It is also disallowable expenses under the capital gain tax. So these are the disallowable expenses under the capital gain tax. So I hope we understand this. Hello?
Yes,
Yes,
sir.
sir.
Okay, thank you.
There's a question at the comment section.
Okay, I will look at the question. He said, kindly explain the basis of assessment according to the new law. Under the new law, capital gain tax is assessed on preceding year basis. Capital gain tax the gain you make in 2025 is going to be assessed to tax in 2026. The gain you make in 2026 is going to be assessed to tax in 2027. So when we talk about the new law, that means any transaction starting from this year relating to disposal of an asset, and you now make a capital gain tax, you make a chargeable gain. Such gain is going to be assessed to tax in 2027 year of assessment. And The word preceding year basis depends on who makes the gain. If it is company, do you understand? The capital gain tax will be assessed to tax not later than 6 months after the end of the year. But if it is an individual, the capital gain tax will be assessed to tax not later than 3 months after the end of the year. That is what that preceding year basis means. So that is that. Now, rate of capital gain tax. What is the rate that we use?
Sorry, please, I have a question. Sorry, about the what's it called, about the company basis of assessment. Is it that after the 6 months after the accounting year end, or after the year end, normal year end?
After the accounting year end, 6 months
sir.
after the accounting year end.
Okay.
Yes, you file the capital gain tax along with the company income tax return. So, rate of capital gain tax.
Hello, sir.
Yes.
There's a question, sir. Still on that
Please,
assessment period.
Can you send your question through chat box so that please I will attend to the question. Send it through chat box. Yes. The rate of capital gain tax. What rate do we use to compute capital gain tax? Under the old law, there is a particular rate, fixed rate, to compute capital gain tax under the old law, which is 10%. Capital gain tax is computed at the rate of 10% under the old law prior to enactment of NTA 2025. Either that gain is made by individual or is made by the company. We use flat rate of 10%. But under the NTA 2025, any chargeable gain or capital gain arising from disposal of assets is going to be taxed based on either company income tax rate or personal income tax rate. If the gain is made by company, the capital gain tax rate we will use will be company income tax rate, which can either be 0% or 30%. Take for instance, if such gain is made by small company that their turnover fall below threshold of 100 million naira, that means their own capital gain tax too will be taxed at 0% based on section 56 of NTA. But if the gain is made by a large company that have a turnover that is above 100 million naira, such capital gain is going to be taxed at the rate of what? 30%. So, regarding the rate of capital gain tax, the rate of capital gain tax is based on the rate of company income tax or personal income tax. In the case of individual, if the gain is made by individual, that means we are going to apply personal income tax rate, which is progressive tax rate. First 800,000, 0%. Next 2.2 at 15%. And so on like that. So the rate of capital gain tax depends on who makes the gain. Is it individual or is it company? If it is company, we can use 0%, we can use 30%. If it is individual, we can use the personal income tax rate. So that is on the rate of capital gain tax. Now, capital gain tax return and penalty for late filing of return. What is how do we file capital gain tax return, and what is the penalty for late filing of return? Capital gain tax return, like I said earlier, under the basis of assessment, we file capital gain tax return along with company income tax return. and such return is filed 6 months after the end of accounting year end of the company, in the case of company. So if we want to file capital gain tax return, anytime we want to file our company income tax return, that gain, that chargeable gain, will be added as other income under the company income tax. We put it as part of our other income, so that we can apply the rate of 30% on it. So any transaction that started from 1st of January 2026, that means we are going to file the capital gain tax return along with the company income tax return in 2027 year of assessment. In the case of individual or partnership, we file it along with our personal income tax return. Failure to file capital gain tax return, what is the penalties? Under the NTAA, Nigeria Tax Administration Act, failure to file capital gain tax return is going to attract a penalties, 100,000 for the first month of the failure and 50,000 for each subsequent month in which the failure continued. Failure to file capital gain tax return, what is the penalties? The penalty for failure to file capital gain tax return is stated in the NTAA, Nigeria Tax Administration Act, and it states that when a person or company fail to file capital gain tax return, or they file an incorrect return, or they try to mislead tax authorities, giving false return, they will pay a penalty of 100,000 for the first month of the failure and 50,000 for every month in which the failure continues. However, tax authority, apart from these two penalties, tax authority, they are now given power under the NTA to issue additional administrative penalties under the Nigeria Tax Act 2025, Nigeria Tax Administration Act 2025. Tax authority have a power to impose administrative penalty apart from these penalties stated above. So that is the penalty for failure to file capital gain tax return. Now, let's go to the major crux of the matter in this topic. How do we compute capital gain tax? Computation of capital gain tax. What is the format for computing capital gain tax? If we look at section 39 of NTA, section 39 of Nigeria Tax Act 2025, it states out the procedure, the step, the format in which we can use to get our chargeable gain, or we can use to get our capital gain. So that section 39 said, if you have claimed capital allowance on an asset, if you now later dispose the assets, if you want to compute the capital gain tax, if you want to compute the capital gain on that asset, sales proceed less tax written down value, where you have claimed capital allowance on that asset. But second step mentioned in that section 39 is where we don't have evidence that capital allowance have been claimed on the assets. There is no evidence that they have claimed capital allowance on the assets and the asset was disposed. How do we compute the capital gain tax? sales proceed less cost of acquisition. So where capital allowance has not been claimed on the assets, if you want to compute the capital gain or chargeable gain, sales proceed less cost of acquisition. But where capital allowance has been claimed on the assets, if you want to compute the capital gain or chargeable gain, sales proceed less what? Tax written down value. So I state the format for better understanding. I said, number one, where capital gain is not claimed on the asset disposed. So how do we compute the capital gain tax? We get our sales proceed with less incidental cost of sales. That means incidental disposal, cost of disposal. Like advertisement cost, like agency fee. We less it from the sales proceed. We get our net sales proceed. From our net sales proceed, we now less our cost of acquisition. We get our capital gain. From this capital gain, we can now apply the rate of capital gain tax on it. That is where capital allowance is not claimed on the assets. Where they have not claimed capital allowance on the assets, this is the formula for computing the capital gain tax. Let's look at example one. Example one. ABC Limited acquire a motor vehicle for use in its business on January 2024 at a cost of 8 million naira. By the date of disposal in 2026, the company has claimed capital allowance amounted to what? 6 million naira, leaving the tax written down value to be 2 million naira. The vehicle was subsequently disposed for how much? 8.5 million naira. And the company incurred advertisement expenses of 200,000 in connection with disposal. Require compute the chargeable gain and the CGT. We are asked to compute the capital gain and capital gain tax. So, how much in this question? How much is the sales proceed of the asset? How much the asset was disposed?
8.5 million.
8.5 million.
5.
So, with less incidental cost of disposal, which is advertisement cost, 200,000. We also less cost of acquisition. Cost of acquisition. How much is the cost of acquisition on this asset?
8 million.
8 million. So when we less that, we get our capital gain or chargeable gain. We compute a capital gain tax. In this question, we assume that they did not claim capital allowance on the asset. That is why we do it this way. Where capital allowance has been claimed on the assets, how do we get the capital gain tax? where capital allowance has been claimed on the asset. How do we get the capital gain tax? All what we need to do where capital allowance has been claimed on the asset, if we want to get the capital gain tax, is for us to say the tax written down value by saying, our tax sales procedure 8.5 less tax written down value. How much is the tax written down value on this asset? 2 million. Less incidental cost of disposal, advertisement cost, 2.2. We get our capital gain tax. That is in that instance. So now in this question, we are told capital gain tax, capital allowance has been claimed on the assets. So we are told capital allowance have been claimed on the assets. So in such instance, we can now say 2 million, our tax written down value, instead of our cost of acquisition, tax written down value is what we will use, 2 million. 8.5 minus 2 million minus incidental cost of disposal. So what are we going to get? We are going to get 6.3 million. I have to send the correction of this. 6.3 million. Because we are told capital allowance has been claimed on the assets. Sales proceeds, less tax written down value, less incidental cost of disposal. That is how we will get our chargeable gain. 6.3 million will be our chargeable gain. So 30% of 6.3 million, what will be the 30% of it? % of 6.3 million.
1.89.
1,890,000.
1,890,000. So that is the correct one. 1,890,000. Because we are told capital allowance has been claimed on the assets. So I have to make some little correction. Example 2 supposed to be example 1. Why example 1 supposed to be example 2? So look at this example 1. XYZ Limited acquire a plot of land in April 2024. For how much? For 25 million naira. In 2026, the company disposed the land for how much? 60 million naira.
60 million.
The following expenses were incurred in connection with the acquisition and disposal of the land. They incur legal expenses, valuation fee, advertisement expenses. Require, compute the chargeable gain. In this question 1, example 1, we are not told, we are not given information relating to capital allowance. Abi? We are not given any information relating to capital allowance. So in that regard, we can use this formula by saying that sales proceed, less cost of acquisition, less incidental selling expenses. So we can use this formula where capital allowance has not been claimed on the assets. So how do we compute that? We know the land was disposed for 60 million. And the land was originally acquired for how much? Cost of acquisition of the land.
25 million.
25 million. We also less legal expenses. We less valuation fee. We less advertisement fee. At the end of the day, our chargeable gain is what? 30 million naira. That is our chargeable gain, 30 million naira. Since we are not told capital allowance has been claimed on the assets. So this chargeable gain, once we get this chargeable gain of 30 million, we are not going to take it to our adjusted profit. We are going to take it at when we want to compute our company income tax. We are going to take this chargeable gain as part of our other income, so that we can apply the rate of 30% on the chargeable gain. But if the question asks us direct to compute the capital gain tax, we don't need to take it to anywhere, just to apply 30% on each. 30% of 30 million. We get our capital gain tax.
Please come again, sir.
What we are saying is, we have get our chargeable gain.
Yes, sir.
30 million. This chargeable gain, we can go and add it to our accessible profit under company income tax. So that if we want to apply 30% on that accessible profit, it's going to include the chargeable gain. That means we have merged capital gain and capital and company income tax together. Another thing we can do, if the examiner asks us separately, compute the capital gain tax after we get this chargeable gain, is for us to apply the 30% on it. So it's still the same thing. But in this question, we are asked to compute chargeable gain alone. We are not asked to compute the capital gain tax.
Okay. So understood, sir.
Yeah. Okay. Rabiat, what is your question?
Yes, sir. I want to confirm if I get it correctly from your first scenario. So are you saying that when we have our taxable profit, right, we can add the capital gain to it and then now apply the tax rate? I don't know if you get my...
Correct.
Okay.
That is what we are saying. So that is what the standard state. Do you understand? If we are giving adjusted profit, we are giving a profit from our trading activities. We have adjusted profit. With less capital allowance from the adjusted profit, we get the taxable profit. We now put the chargeable gain to it. We add the chargeable gain to the taxable profit. We apply the 30% capital gain tax.
Good evening, sir.
Yes.
Sorry, what if it's lost?
What is if it is lost?
Yes, please.
You ask a good question. Loss from, maybe you have a taxable loss. We cannot use the taxable loss coming from your business to relieve capital gain. If you have a capital loss, you cannot use capital loss to reduce your taxable profits. If you have a capital loss, you can carry the capital loss forward. That means you not take it to, you not add it to the taxable profit. You will carry it forward. But if you have a, maybe you don't have a taxable profit, you have a loss under your company income tax, and you have a chargeable gain. That gain is going to be assessed to tax at the 30% rate. That loss under your company income tax is going to be carried forward. You cannot use chargeable gain to relieve loss from trading profits. Likewise, too, you cannot use profit from trading, taxable profit, or adjusted profit, accessible profit from trading activity to relieve capital loss. Do you understand?
Thank you.
Yes. So that is the explanation.
I have a question. My hand is up.
Okay. You can ask your question.
Yes, sir. I don't know if I got you correctly, but I don't know, you said something about adding the chargeable gain to the adjusted profits and not to the taxable profits.
Yes.
Okay, so going to be added to the adjusted.
There is a format. There is a format. When you get adjusted profit from your trade. Do you understand? When you get adjusted profit from your trade, there is a particular standard specified by the Nigeria Revenue Service. Once you get adjusted profit from your trade or accessible profit from your trade, before you less capital allowance from that trade, the law say you should add capital gain. You should add what? Capital gain.
Okay, sir. I just wanted to be sure that we are adding it to adjusted profit and not taxable profits. Thank you,
Not
sir.
taxable profits before the deduction of capital allowance.
All right, sir. Thank you, sir.
Okay. So let's continue. Now, we have looked at two ways for computing capital gain or chargeable gain, where capital allowance is not claimed on the asset. We use cost of acquisition to less it from sales proceed. But where capital allowance has been claimed on the asset, we less tax written down value from the sales proceed. And we also less incidental selling cost from the sales proceed. So we have looked at the two illustrations. This one is where capital allowance has been claimed on the asset. Look at it. The sales proceed is 8.5. The tax written down value is 2 million. The incidental selling cost, advertisement, 200,000. We less it to get 6.3. That is the chargeable gain. the examiner go ahead to say we should compute the capital gain tax. So since they ask us to compute the capital gain tax, we don't need to take this chargeable gain to adjusted profit. We should just apply 30% on it. 30% of 6.3, it will give us 1,890,000. So we have looked at the two. You should have it in mind. When they said capital allowance has been claimed on the asset, you should know you have to use tax written down value. Let's mute our audio. Now, let's continue for the sake of time. What are the assets or gains subjected to capital gain tax? Assets or gains subjected to capital gain tax. What are the assets or gains subjected to capital gain tax? Assets or gains subjected to capital gain tax. If you look at section 13 of NTA, section 34 of NTA, it states out those assets or those gains that are subjected to capital gains tax. Number one, as stated in the section 34 of NTA 2025, is called incorporeal properties. Incorporeal property, they are intangible assets like goodwill, copyright, trademark, patent rights. It is stated under the capital gain tax. It is stated under the NTA 2025 that they are subjected to capital gain tax. When you sell a company, that company, the net asset is 500 million. But you want to sell the company 700 million naira. The difference between the purchase consideration of that company and the net asset, the difference between 700 million and 500 million, that means that is the goodwill. That goodwill of 200 million, you will pay capital gain tax on it. Likewise, too, you have a copyright. You sell your copyright, you will pay capital gain tax on it. Trademark, patent rights. So they are the incorporeal properties. So they are one of the assets subjected to capital gain tax. Some of these incorporeal property, they may not have acquisition costs. They will just have sales proceeds. They will not have any acquisition costs. They will just have sales proceeds. Like trademark is how much you are selling the trademark. You will know. They will not tell you this is how much you buy the trademark. No, it doesn't have cost of acquisition. So one of the assets or gains subjected to capital gain tax is called incorporeal properties. They are the intangible assets such as goodwill, copyright, trademark, patent right, etc. Another asset or gain subjected to capital gain tax is called options. Options. What do we mean by options? Options means purchasing rights. Purchasing what? Purchasing rights. Purchasing rights. This option means you are given an option to buy a product at a reduced rate if you can buy some number of quantities. Let me give an example. Dangote Refinery give one of the filling station, one of the major filling station, an option that, come and buy 50 truck of PMS. If you can buy 50 truck of PMS, instead of selling one truck for you at the rate of maybe 20 million naira, we will sell it for you at the rate of 18 million naira. One truck, since you want to buy 50, we give you an option to buy 50 at once. The normal price is 20 million per truck. But if you can buy 50, we will reduce the rate for you to sell it 18 million naira per truck. Since the filling station giving the option may not have money, enough cash flow to exercise the option at a time, they may not have money to exercise the option. They may not have the cash flow to buy the 50 truck at once. What they can do, they can look for another filling station. Look for two or more filling stations. Go and approach them. Tell them that I was given an option to come and buy 50 truck. Out of the 50 truck, I will sell 10 truck for you at the rate of 19 million naira, so that you too can benefit. So the company giving the option, they can sell the option to another filling station, so that the number of truck will complete 50. They will now sell the option. Indirectly, they have made a gain. Dangote want to sell it for them 18 million naira. They have sold it to another filling station, 19 million naira. They have made a gain of 1 million. That 1 million gain will be subjected to capital gain tax. That is an option, purchasing rights. So they have to look for another company so that they can exercise the options. That is option. So that 1 million, that extra 1 million naira will be subjected to capital gain tax. That is option we are referring to in this capital gain tax. Another asset or gain subjected to capital gain tax. Another asset or gain subjected to capital gain tax is called debt. Debt too is subjected to capital gain tax. This one applies to those companies that deal with debt factoring. This one applies to those companies that deal with debt factoring. Somebody is owing you money. He's owing you 70 million. He's promising you he's going to pay in 90 days' time. You cannot wait. You now want to sell the debt to another company. The company now said, the 70 million that they are owing you, I will buy it for 65 million and I will wait for 90 days. Indirectly, that company has made a gain of 5 million naira. That gain that the company make, it is subjected to capital gain tax. So debt too is subjected to capital gain tax. Some people acquire debt. Some people, their own business is to acquire debt. If somebody is owing, a debtor is owing another company, they can buy off the debt. If they are owing maybe 70 million, they can buy the debt 65 million, so that they can collect 70 million from the company owing the debt. So that gain, the difference between the actual debt amount and the paid, discounted amount paid to the original creditors, is the capital gain, and that company will pay capital gain tax. So another asset subjected to capital gain tax is debt. Another asset subjected to capital gain tax, any currency other than Nigeria currency, that means foreign currency. When you make a gain from disposal of foreign currency, you will pay capital gain tax. You buy dollar when the rate of exchange is maybe 800 naira per dollar. When you buy dollar at that rate, when the rate of exchange is now 1,005 per dollar, you now want to sell the dollar. That dollar you have make a gain. That gain, it is subjected to capital gain tax. So disposal of any currency other than Nigeria currency, foreign currency, in such instance, you will pay capital gain tax. Another asset subjected to capital gain tax is stock and shares of every description. When you sell stock or you sell your shares, they are subjected to capital gain tax. However, under the asset exemption for capital gain tax, there are some stock, there are some shares, they are exempted from capital gain tax. We still look at them. It is not every shares, every stock are subjected to capital gain tax. There are some shares, stock that are exempted from capital gain tax. We look at them while we are looking at gain or assets exempted from capital gain tax. So one of the assets or gain subjected to capital gain tax is stock and shares of every descriptions. They are subjected to capital gain tax. Another one is all qualified capital expenditures. All qualified what? Capital what? Expenditures. What are the all qualified capital expenditures? Plant and machinery, furnitures and fitting, motor vehicle, land and building. When you dispose them, they are subjected to capital gain tax. Any qualified capital expenditure, when you dispose such qualified capital expenditure, they are subjected to what? Capital gain tax. Like land, building, motor vehicle, furnitures and fitting. They are all qualified capital expenditures. Another asset subjected to capital gain tax, digital or virtual assets. Digital or virtual assets. This one was introduced by NTA 2025. NTA 2025 specifically recognized digital or virtual assets as chargeable assets. It's one of the major changes that was made to capital gain tax in the new tax law. Right now, if you are into cryptocurrency, you are into virtual currency, you are into digital token, you are into all this online business, you are into online gold, you will pay capital gain tax when you make gain from such digital transaction or from such virtual transaction. Even there is a modality, there is a framework on how you are going to tax virtual assets. Federal government, the Nigeria Revenue Service, they have designed a framework on how virtual assets will be taxed. They even set up a committee on how on the implementation of virtual asset tax. So it's one of the major areas government focus on the attention on. So it's one of the major changes that was introduced by the new tax law, introduction of taxation of virtual assets, most especially chargeable capital gain tax on virtual assets. So it's part of the assets that are subjected to capital gain tax. So if you are asked, what are the assets subjected to capital gain tax? I've listed them. Digital or virtual assets, all qualified capital expenditure, stock and share of every description, any currency other than Nigeria currency, debt, option, incorporate properties. So we should have it in mind. Examiner can try to ask some funny question here. If examiner asks us assets, we list the asset direct. Incorporate property, we give example. Option, we explain. Debt, we explain. Examiner is asking us assets subjected to capital gain tax. Qualified capital expenditure, we give example. But if the examiner asks us, what are the gains subjected to capital gain tax? I can normally treat this question. If they ask you gains subjected to capital gain tax, if I were you, I will start by saying gain arising from disposal of incorporeal properties. I will go further. Gain arising from disposal of options. Gains arising from disposal or factoring of debts. Gains arising from disposal of any currency other than Nigeria currency. That is how you address that. You should know the difference between the two. So if they ask you gain, if you leave the asset direct, you will not get the answer. So I think my explanation is clear here. Hello?
Yeah, with
Hi.
you.
Yeah, with you, sir.
Okay. Now, assets specifically exempted from capital gain tax. What are those assets that are exempted from capital gain tax? What are those assets that are exempted from capital gain tax? Assets specifically exempted from capital gain. If you look at section 34 of NTA, you will see those assets too. Assets exempted from capital gain tax. If you look at section 34 of NTA, Nigeria Tax Act 2025, you can see those list of assets too. One of the assets exempted from capital gain tax or gain exempted from capital gain tax. It can ask you assets exempted from capital gain tax or gains exempted from capital gain tax. Disposal of Nigeria government security. When you dispose government security, either state government or federal government security. What are the federal government security? What are the state government securities? Bond, when you dispose bonds, when you dispose government stock, when you dispose municipal bond, when you dispose sukuk bond, revenue bond, you dispose treasury bill. All these are government security. They are exempted from capital gain tax. They are exempted from capital gain tax. So, take for instance now, I acquire a bond, federal government bond. I acquire bond of 10 million naira. After 3 years, I want to sell the bond. The bond now have a value now. The value of the bond is now worth 20 million naira or 15 million naira. That 5 million naira gain I made, they will not ask me to come and pay capital gain tax because it's a government security. Gain on disposal of government security is exempted from capital gain tax. Another one, gain accrued to government authority. If a government authority like federal government, state government, local government, if they dispose an asset, they make a gain. Take for instance now, state government dispose a land, they make a gain. They will not ask state government to come and pay capital gain tax. A local government, if they dispose asset, they dispose motor vehicle that they have been using, they make a gain. They will not ask them to come and pay capital gain tax. So any gain accrued to government authority, any gain arising from disposal of an asset by government authority, like federal government, state government, or local government, or any government agency, it is exempted from capital gain tax. Another one, any gain accrued to organization like charitable organization, educational institution of a public character, register-friendly societies, any gain accrued to cooperative society, trade union, all these gain, they are exempted from capital gain tax. Gain from disposal of an asset by educational institution, by friendly society, by non-governmental organization, by cooperative society, all these, they are exempted from capital gain tax. So they are exempted from capital gain tax. Another asset or gain exempted from capital gain tax, gain arising from disposal of life assurance policy. What do we mean by this? Gain arising from disposal of life assurance policy. You insure your life, you are giving compensation from insurance for doing life assurance policy. Such gain is not subjected to capital gain tax. Somebody insure his life in case of any eventuality. That person is now, something event now occur. That person is now late. Insurance now pay compensation. Such gain, tax authority will not say, come and pay capital gain tax. It is not allowed. Another asset or gain exempted from capital gain tax, personal chattel. This one was introduced by the new tax law. NTA 2025 was the one that introduced this personal chattel. When an individual disposes their personal chattel, tangible, movable personal properties, it is exempted from capital gain tax. This one applies to individual. Gain arising from disposal of an individual tangible, movable personal property, personal chattel. What you are using in your house, personal. You are not using it for your business, so you are using it personal, like your television, like your fan, like your jewelries. When you dispose them, you now make a gain, provided that the sales proceeds of such disposal is not more than 5 million naira or 3 times annual wages, whichever is earlier, whichever is higher. Annual minimum wage is 70,000 times 12. That is 840,000. 840,000 times 3. How much is he going to give us? So if an individual disposes personal chattel that is not more than 840,000 times 3, such gain will be exempted from capital gain tax. 840,000 times 3. $2,520,000. Either 5 million or 2,520,000. Which one is higher? 2,520,000 is higher. That means when you dispose any of your personal belongings that you are using for your household, and the sales proceeds is not more than 2,520,000, such gain you make from the disposal will not be subjected to capital gain tax. This was introduced specifically by NTA 2025 Before last year, we don't have this. It is one of the changes made to capital gain tax in the new tax law. Another one, gifts. When you are giving a gift, you are giving a gift. You acquire an asset by gift. Somebody give you an asset. Such an asset given to you by gift. You now subsequently dispose the assets. In such instance, you will not pay capital gain tax. An asset is given to you by way of gift. Later, you now dispose the assets. When you receive consideration from such disposal, such consideration will not be subjected to capital gain tax. However, when an asset is given to you by gift through inheritance, maybe your father will a property to you by way of inheritance. In such instance, if you dispose such property, you will pay capital gain tax. You inherit an asset by way of inheritance as a result of death of the original owner. In such instance, if you dispose such an asset, you will pay capital gain tax. But if you are given an asset by gift by another person that is still alive, and you now later dispose the assets, you will not pay capital gain tax. Another asset or gain exempted from capital gain tax. Gain from disposal of private residents, residential apartments, residential house. When you dispose your residential house, the house you are residing, maybe you are residing in Lagos, you are from Oyo State, you have built house in Lagos, you have spent 30 years in Lagos, you have house in Lagos. So you are now 85 plus, 70 plus, 70 years plus. So what you'll be having in your mind, let me relocate back to my hometown. So in case of incasity. So you can dispose your asset to your personal residence you have in Lagos. If you dispose such personal residence you have in Lagos, your residence, your property you have in your land, your building you have in, if you dispose it, you will not pay capital gain tax. But this disposal of private residence is only once in a lifetime of an individual. What do we mean by that? Once in a lifetime of an individual. What do we mean by once in a lifetime of an individual? And there must be evidence that your personal residence, that your private residence, you are not using it for business. You are not using it for trading. If you are using it for trading, you are using it for business, it will be subjected to capital gain tax. But if you are using it for your residential, your family is living there, you are using it to sleep, you understand? You will not pay capital gain tax. But that private residence is once in a lifetime. What do we mean by that? Maybe somebody that have 3 private residents. He has house, the person have house in Lagos State. He has house in 3 different locations in Lagos State. He has one in Yanopada. He has another one in Surulere. He has another one in Aja. Once he dispose one out of the 3, he will not pay capital gain tax. But anytime you want to dispose the other 2, despite that other 2 is also private residence, that other two, they will be subjected to capital gain tax. So disposal of private residence is available to an individual once in the lifetime of an individual. The first one you dispose of your private residence is the one you will not pay capital gain tax on.
Hello, sir.
Yes.
What about these residents are being used for private or
This,
personal extended family?
so far as you are not using it for business, it's not using for trading, it's only residential portion, only residents. You are residing, you may have a tenant, but having tenant does not mean it's not a residential apartment. If we are giving that you are using it for one of your company, one of your business, one of your trade, one of your profession, you are using it as part of your office, that one is not residential again.
No, sir.
You can use, okay.
Sir, what I'm saying is that if it is used, if the other ones are being used for extended family, like some of these brothers that
Extended
use
family, it's still a private residence. It's
Yes.
still a private residence.
Yes, and you dispose one, and then later you dispose one of the private ones that was being used by extended family. Must you also pay
Once
on
you
that
have
one?
disposal is once in a lifetime of an individual. Once in a lifetime. Only one of your private resident you can dispose that you not pay capital gain. If you dispose any other one, likewise too, that disposal too, your private residence you want to dispose must not be, the land must not be more than 1 acre of land where you are staying that you want to dispose. If it is more than 1 acre of land, you will pay capital gain tax. This was introduced by the new tax law. It's one of the major changes made to capital gain tax under the NTA 2025. We don't have this before. So,
I have a question.
what is your question?
Yeah, you mentioned something earlier about having tenants. So if a landlord that has tenants decides to sell his house, once that's the first time he's selling his house, he's not going to pay capital gain tax.
Yes, it's not for business. So the word tenant does not mean you are doing business. Yes, it's not for business. It's not for business.
That's the source of income.
But it's more or less
That's the only source of income.
but it's more or
The
less
way you are
like an
taking it to,
investment.
so far as you are residing in that apartment, or one of your family is residing there, even though you have a tenant, it's still a residential apartment. What the law says, maybe you have a pure water business, maybe you are using it for your pure water factory, that one is business. Or you are using it for any of the trade, or you are using it as part of your store, as your store. Do you understand? So, but by looking at asking your question, some of these questions can be addressed through the legal means, but we are stating what the law states based on what I think is what the law is saying.
Okay, sir. Thank you, sir.
Yes. So this was introduced by the new tax law, NTA 2025, Nigeria Tax Act 2025, is one of the major changes made to capital gain tax too. When they want to mention that land that you are using for private resident, you are using for your private resident, or you are residing, that land must not be more than what? 1 acre of what? Of land. Another asset or gain subjected to capital, exempted from capital gain tax for the sake of time. Another asset or gain exempted from capital gain tax. Gain received by way of compensation for personal injury. You receive a gain by way of compensation, or you receive damages by way of compensation for personal injury or professional injury or loss of office or loss of employment. So when you receive a compensation or you receive a damage for loss of office, loss of employment, or for injury suffered, provided that that compensation you receive is not more than 50 million naira, such compensation will not be subjected to capital gain tax. Then when the compensation is more than 50 million naira, the excess will be subjected to capital gain tax. Take, for instance, you are one of the director of one of the major banks in Nigeria. So the bank now want to do some they want to redefine the company, the bank. So they have to lay off some of the directors. So they are now giving compensation, payoff cap package. So if you are a director and you are giving compensation for loss of your job, loss of your employment, you are one of the executive directors, you are now paying, they now pay you 300 million compensation. That 300 million, 250 million will be subjected to capital gain tax. Only 50 million will not be subjected to capital gain tax. So 250 million will be subjected to capital gain tax. So the excess will be subjected to capital gain tax. So compensation received by way of damage or injury suffered or loss of office. So provided that the amount is not more than 50 million naira, they are exempted from capital gain tax. Another asset or gain exempted from capital gain tax is chargeable gain arising from disposal of assets by diplomatic mission or foreign embassy. If an embassy, a foreign embassy in Nigeria, dispose an asset, and if they make a gain from such asset is not subjected to capital gain tax. Let's say, for instance, American embassy in Nigeria, they dispose one of their motor vehicles, they now make a gain. Such gain is exempted from capital gain tax. Any gain, any chargeable gain accrued to diplomat or diplomatic mission, they are exempted from capital gain tax. Another gain or asset exempted from capital gain tax, compulsory acquisition of land by government. Any gain arising from compulsory acquisition of land by any government in Nigeria. Your company is located in Lagos-Ibadan Expressway. Government want to expand Lagos-Ibadan Expressway, or they want to do a rail station. They now say, this your company, no. They have to acquire it by compulsory acquisition, no, for road expansion. Do you understand? That one is compulsory acquisition of land. If government acquire your land through God. Please, let's mute our audio. If government acquire a land from company or from individual by way of compulsory acquisition, such acquisition will not be subjected to capital gain tax unless there is an evidence that the owner of the land has intention before that he want to sell the land. We receive government have an evidence that before government want to acquire the land for road expansion, the owner is willing to sell the land before. He's looking for buyer. In such instance, that person will pay capital gain tax. But if the person is not looking for buyer, he doesn't have the intention of selling the land, Government just come. They write a letter to them that, this is your land, we want to expand the road, road have to pass your place, so by virtue, you have to demolish your building. In such instance, that is compulsory acquisition. So gain arising from compulsory acquisition of land by government is exempted from capital gain tax. The only exemption is when the owner has an intention, or the owner has already negotiated that he wants to sell the property before. In such instance, such gain will be subjected to capital gain tax. Are we making sense? Hello?
Yes, please.
Are we still together?
Yeah. Yes, sir.
Another one, another gain or asset exempted from capital gain tax. Disposal of shares in Nigeria companies. When you dispose shares and the total value within 12 months, you dispose a share, maybe you have a share, you now dispose a share, and the total value of such shares is not more than 150 million. And the capital gain on such shares too is not more than 10 million within 12 months. Such shares you dispose will not be subjected to capital gain tax. You have a shares in a company, you dispose it through your stockbroker, and within 12 months, the total value of the disposal of that share you dispose, somebody like Otodela, they may have a shares that worth more than 150 million. Don't let me mention it. Some people have a shares that worth billions of naira. Such kind of people, they are investors, they are majority shareholder. They now dispose the share from the share they have in such company, they dispose it. When they dispose it, if within 12 months, they can be disposing it in a piecemeal. Maybe they first dispose 50 million, they dispose 30 million. If they now add it together within 12 months, they now think that the total value of the disposal is no more than 150 million. And the capital gain that they make from the disposal is no more than 10 million within that 12 months. Such disposal of shares is not subjected to capital gain tax. However, if you dispose of shares, you now make a gain that is more than 10 million naira. Are you going to pay capital gain tax or you are not going to pay? Hello? You dispose of shares. The value, the gain you make on such shares is more than 10 million naira. Are you going to pay capital gain tax or you will not pay?
You pay.
You pay. You pay capital gain tax.
You will pay. Let's say, for instance, I dispose of shares of 45 million naira. It's not even more than 150 million. And now make a capital gain of 15 million naira. Am I going to pay capital gain or not? I'm going to pay capital gain.
You pay.
So there are two exemptions. I want to ask a second question. I dispose a share. The sales proceeds of that disposal of share is 450 million. But I make a capital gain of 7 million.
Pay.
I make a capital gain of 7 million.
Pay. No. You won't pay.
Am I going to pay capital gain tax or not?
No, you know.
You will pay because
capital
you
gain
met
tax.
one of the conditions.
You pay capital gain tax.
You will not pay.
It's
A
critical.
450
Pay. One
million share.
condition is met. Condition
Your gain
A,
does not
condition A
exceed
is
10
met.
million.
So you will pay.
A 450 million shares. And I make a capital gain, chargeable gain of 7 million. Am I going to pay capital gain tax or not?
Yes,
will
No,
not
you will
pay.
not
you
pay.
pay.
Do not pay.
You will
Take
pay.
You will not
You will
pay.
pay. Condition A is
You,
met.
you will not pay
You will not
Thank you.
pay.
We won.
Yes,
because you will not pay.
you pay.
The chargeable gain must not exceed 10 million naira. You will not pay.
So the chargeable gain is superior in this condition.
Yes, chargeable gain is superior.
Superior to proceed, right?
Yes. So these are the gain or assets exempted from capital gain tax. Let's look at one more. Another gain or asset exempted from capital gain tax. A motor vehicle, car, used solely by an individual for private, non-commercial purpose. You have your car, your personal car that you are driving. When you dispose it, you will not pay capital gain tax. So private motor vehicles used for private purpose, you are not using it for business. So when you dispose it, you will not pay capital gain tax. And maximum of 2 vehicles in a year of assessment. This one applies to individual. It does not apply to company. No. This was introduced by the new tax law too. When an individual disposes motor vehicle, when they make a gain, that motor vehicle, if they are using it for their personal, they are using it private, they are not using it for commercial purpose, they will not pay capital gain tax. A maximum of 2 private vehicles you can dispose in a year of assessment. Maximum of 2 private motor vehicles. That is what we can dispose in a year of assessment. In such instance, you will not pay capital gain tax. So you can be asked, what are the gain or assets exempted from capital gain tax? I've listed them. I've been explaining them since. So please, let's take note of this area. It's very important. They are almost like 13. So it is specifically stated in the section 32 of NTA 2025.
Sorry, 32 or 34?
34, sorry, 34. Section 51 of that NTA talk about private resident too. Section 51 talk more about the private residents. So, any question before we proceed? So that we can look at connected person transaction. Connected person transaction is where we are going to end this night. We are going to solve a question in connected person transaction and we end the class. So, Mr. Matthew, what is your question?
Yeah, so concerning the private residence that an individual can only claim it once in a lifetime. So can I use my discretion as a person to decide to pay, to pay tax in this regard? Maybe if I have a property and I see that I might want to sell other ones later, I can decide to pay at a particular time, or it has to be the first property you sell from this tax, from this current tax.
Based on what the law say your first property once in a lifetime. Okay, the law say once in a lifetime. Every individual have opportunity to enjoy this section 51 once in a lifetime. So if you now have 3 property, if you say you want to pay capital gain tax on the first one, you can pay. If you now send the second one, you can enjoy that exemption once in a lifetime. Every individual has opportunity to enjoy that exemption once in a lifetime. So if you have enjoyed your own, you cannot enjoy again. But if you are here to enjoy your own, you can still enjoy.
But is there any limited time, sir?
There is no limited. No, there's no limited time. Hello?
Yes, I'm with you, sir.
Okay, there is no limited time. So far as you are still alive.
Life.
Because if I decide to defer my own for later, is
there will be new law before that, my brother. Law. Tax is dynamic. Tax is law. In the next 3 years now, we have a new law again. We have a new law. I promise you. So this where we are going to end this night is called connected person transactions. Connected person transactions. That is where we are going to end this night. Connected person transaction. What do we understand by connected person transactions? Who are the connected persons? Connected person means two or more parties that are related either by blood or through business. They are the connected persons. Two or more persons or two or more parties that are related either through blood, through family ties, or through business. They are connected persons. And transaction between connected persons under the tax law, we regard it as artificial transaction. That means those transactions that is not done as arm's length. So, in relation to capital gain tax, when two connected parties transact capital gain, they transact an asset. One party dispose an asset to another connected party. We are going to consider the market value of that asset. We are not going to use the sales proceeds used by the party unless the sales proceeds is more than the market value. But when the sales proceeds is less than the market value, when we want to compute the capital gain tax, we are going to use the market value as the sales proceeds. Because connected person transaction, we look at them as transaction that is not done as arm's length. They are connected together. So they are connected. So transaction that is not done as arm's length. You can be family. You can be business partner. Example of connected persons. What are the examples of connected persons? Examples of connected persons. Number one, an individual is connected to his or her spouse or relative. An individual is connected to his or her spouse or relative. An individual is connected to his or her spouse or relative. It's an example of connected persons. You are connected to your wife. Wife is connected to husband. You are connected to your family. A trustee of a settlement is connected to the beneficiary. A trustee of a settlement is connected to who? To the beneficiaries. A partner in a partnership business is connected to other partners. A partner in a partnership business is connected to other partners. A company, a parent company is connected to the subsidiary. An agent is connected to the principals. All companies in a multinational company, they are connected together. An associate company, they are connected together. All these are examples of connected persons. Two subsidiaries in a group of companies, they are connected together. An employee is connected to the employers. So all these are the examples of connected persons. What you need to know is that when there is a disposal of an asset between connected persons, we look at the sales proceed. If the sales proceed is less than the market value, we use the market value as the sales proceed. But when the sales proceed is more than the market value, we use the sales proceed. Are we making sense? I've gave example of connected persons. Now let's look at illustration on connected persons. Example 3. Let's look at illustration. Example 3. Cowboys Limited is a manufacturing company based in one of the major cities in Nigeria. In a bid to reorganize the business for future profitability and growth, the board of the company approved the underlisted transaction during the year ended 31st December 2026. A motor vehicle which was acquired in August 2021 for how much? For 2,750,000 was sold to who? To the managing director in October 2026 for 2,550,000. The market value of the motor vehicle at the date of disposal was 2.9 million naira. You are required compute the capital gain, if any, and capital gain tax for these transactions. B, state the date when the tax liability is to be paid to the relevant tax liability, to the relevant tax authority. State the date when the tax liability, if any, is to be paid to the relevant tax authority. Now, we are asked to compute the capital gains and the capital gain tax. In this question, who are the connected persons here? Who are the connected persons? Connected parties here?
The company
The board of
employee.
general manager.
The company and the general managers. So if we want to compute the capital gains, how much will be our sales proceed?
2.9.
2.9. What is our cost of acquisitions?
2.750.
So see, sales proceed 2.9. Cost of acquisition 2.750. So 2.9 minus 2.750. Our capital gain will be what?
150.
So the capital gain tax. The capital gain tax. 30% of
30%, 150.
150. That would be what?
45.
45,000. The question 2. Who can help me attend this question 2? State the due date when the tax liability is to be paid, if any, to the relevant tax authority.
To be June 2027. On or before June 2027. June 30th.
The capital gain tax liability must be paid on or before or not later than 30th of June 2020 what? 2027. So that is it on this question. Do we understand? This is a connected person. As we proceed, we are still going to look at more questions on connected persons. So the next area we have is partial disposal of an asset. Can we look at that before we go? Or we should look at it next week?
Next week, sir.
Next week, sir.
For next
Okay.
week.
Okay.